Just recently, one of Britain's most recognizable companies agreed to disappear from the stock market. Apollo, the US investment giant, agreed to buy EasyJet for about £5.7 billion. And here is the strange part. The offer was 81% above where EasyJet shares traded before takeover interest became public. If the stock market thought the business was worth one price, why was a private buyer willing to pay almost twice as much? And EasyJet is not an isolated case. London has spent years losing companies to overseas buyers and take private deals. Even the FCA is changing listing rules as it tries to make the market more attractive again. So the interesting question is not simply why private equity keeps buying British businesses. It is why Britain keeps producing businesses that somebody else thinks are worth more. Private equity itself is fairly simple. A fund raises money from pensions, institutions, and other investors, often adds debt, buys a business, and tries to make it worth more. That might mean improving operations, expanding, increasing prices, cutting costs, or buying competitors. Eventually, it wants to sell the company, list it again, or otherwise return cash to investors. So the model is basically buy, improve, sell. And the price you pay at the start matters enormously, which is why the UK has become so interesting. British shares have spent years trading at lower valuations than many comparable companies overseas. That does not mean every UK company is cheap, but lower public market valuations create an opportunity for a buyer with a different view of the future. Imagine the stock market values a company at £3 billion. A private equity fund thinks that after 5 years of changes, it could eventually be worth £5 billion. Suddenly offering shareholders £4 billion does not look irrational. It is a huge premium to yesterday's share price, but the buyer can still believe it is getting a bargain. So EasyJet is a perfect example. An 81% premium sounds enormous, yet Apollo still believes the deal can produce an attractive return. And it is not only private equity. Swiss engineering group ABB has just agreed to buy British automation company Rotork for about $5.5 billion. Different buyer, same broader phenomenon. Foreign capital looking at British assets and deciding they are worth owning. And private equity does not need to buy a famous public company to use the same idea. Sometimes it's a lot of small ones. Take veterinary practices. One local vet is a small business. Buy 10, then 50, then hundreds, and suddenly you can centralize purchasing, technology, and administration and operate at much larger scale. That is a roll-up. The UK veterinary market shows how powerful and controversial that model can become. The CMA found average prices at 5 large veterinary groups were 18% higher than at independent practices over the period it examined. For at least 3 groups that had acquired practices since 2015, it estimated acquisitions led to prices around 9% higher after 4 years than the previous trend. That does not mean every acquisition causes higher prices or that every large veterinary chain is private equity owned, but it shows why fragmented industries are attractive. The individual business may be ordinary, the network can be much more valuable. There is another reason a buyer might prefer to own a company privately. A public company is priced every day. Management reports constantly and gets judged immediately when profits fall. A private owner can sometimes make changes that hurt earnings today, but are supposed to make the company worth more years from now. It can restructure, sell divisions, buy competitors, or change the financing without watching the share price react every afternoon. But that freedom does not guarantee better decisions. Private equity can also use too much debt, cut investment too far, or simply make the wrong bet. The point is that a private buyer and the stock market can look at the same company through very different lenses. And increasingly, once companies become private, they can stay there for longer. Traditionally, private equity had an obvious ending. Buy a company, own it for several years, then sell it. But exits have become harder. Higher rates make deals more expensive, IPO markets became less reliable, and buyers have not always been willing to pay the prices private equity firms want. So, continuation funds have surged. The idea is basically this. An old fund owns a company and is reaching the point where it should sell. Instead, the manager can move that company into a new fund, bring in new investors, let old investors cash out, and keep owning it for longer. Manager-led continuation transactions reached about $106 billion globally in 2025. They can make sense if the manager believes the asset still has years of growth left, but the same manager can effectively sit on both sides of the transaction, which is one reason US regulators are now scrutinizing them. So private equity is not only buying more businesses, it has also built more ways to keep them private. Anyway, for an individual shareholder, a takeover can be great. If somebody offers a huge premium for a stock you own, you may be very happy to take the cash. The issue appears when you zoom out. London's stock market has been shrinking for years. Companies leave through takeovers, some businesses list elsewhere, and regulators are trying to attract replacements. If UK companies consistently trade at lower valuations, buyers have more reason to acquire them. Those companies then disappear from the public market, and a smaller market can become less attractive to investors and future companies again. So takeovers are only part of that problem, but the outcome is strange. British pension and investment money increasingly goes overseas, while overseas and private capital keeps turning up to buy British businesses. So when you next see a company that's been bought for 30, 50, or even 80% above its share price, do not just look at the premium and assume the buyer has overpaid. Ask a different question. What does the buyer believe this business is worth that the stock market did not? Because that is the real story behind Britain's takeover wave. Private equity is not buying companies simply because it has endless money to spend. It is buying when it believes the gap between price and value is wide enough to exploit. And if buyers keep finding that gap in Britain, the uncomfortable question is not why they keep buying, it is why Britain keeps selling.